Hello again, everybody. Doing here from DRFX Forex Trading. Taking a look at the most recent trade that was made over the last couple of days. This was on the New Zealand US dollar. As you can see here, the market was breaking out of this range set up on the daily chart with this breakout candle in the form of a bearish engulfing candlestick formation. This was expected to carry us lower towards the breakout equivalent just at this area here. Now, from the theory of consolidation breakouts, the breakout equivalent is the area to which the market heads towards before pulling back or moving sideways when it's breaking out of a consolidation. All consolidations, the small ones, the medium ones, and the large ones, across all time frames, have their breakout equivalent. And measuring this gives us a sort of a target to aim for and allows us to set our targets comfortably and confidently, knowing that the market is going to actually hit that target. So it gives us a way of ensuring that we know where the market is headed so that we can set our targets accordingly. So the market was expected to head towards this area here, but our target of 200 pips was expected to be hit much earlier than that. So we were actually expecting the market to hit this target fairly quickly, because as you know from consolidations, the breakouts from them normally are pretty fast. So targets are normally hit within a few days. Unfortunately, the market had other ideas, as you would know takes place from time to time. At the end of the holding period, which coincides with this bull candle, the market actually pulled back and we actually had to exit the trade for a small loss of 33 pips. So the market moved sideways instead of continuing lower towards our target. Taking a look at what has taken place over the last couple of days with other currency pairs that have similar setups, what you would notice is that there's a pattern when it comes to breakouts from consolidation that coincide or are caused by brief periods of heightened risk aversion. As you can see here, this took place on the Aussie Japanese yen, and in this case, the breakout equivalent of this range was hit. And this was followed by the period of sideways movement and volatility and indecision that we're now seeing here. This is normally expected whenever the breakout equivalent is hit. The market will begin to move sideways and pull back before providing us with another pattern to trade, either against the direction of the original breakout or to continue the movement lower in the direction of the breakout. Another example of this took place on the New Zealand Japanese yen as well. Here you can see that the range breakout took place as a result of the risk aversion, and in this case as well, the breakout equivalent was hit, followed by the movement, the sideways movement that normally takes place when this target is hit. Yet another example was on the New Zealand Swiss franc, where it broke out of its pennant, and the breakout equivalent, not labeled here, but the breakout equivalent of this pennant setup was here as well. And as you can see, the market pulled back sharply after hitting that area there. Even as far back as 2011, the Japanese US dollar, where this range, this pennant setup was formed just ahead of the earthquake that hit that country. Here we can see the result of the market reaction to that event in March of 2011. The market again hit the breakout equivalent of this pennant before rallying sharply to reverse. So generally speaking, what you would find is that whenever we have these types of events across the currency market, financial, political or otherwise, these breakouts and sharp movements normally coincide or lead to the breakout equivalent of the pennant being hit. In this example, I was actually able to take advantage of it in the Dukas Copy trading contest a few years ago. This was one of the trades that actually allowed me to place in the top 10 during that period, in March of 2011, where I squeezed into the top 10 with the, as you can see here. So that was a trade that I had made as part of the breakout from this consolidation, and that trade was taken with the breakout equivalent in mind. So across the currency market, this is what you would normally expect. Even though we have these periods of sharp movements in the currency market, break that are taking place with breakouts from consolidation, you normally the market normally heads towards these breakout equivalent targets before pulling back or moving sideways. So it's a bit of a surprise. So it was a bit of a surprise when the market started to stall, or has now stalled, instead of continuing towards the breakout equivalent of this range setup. Now, after spending a few hours looking back at this trade, I realized that there was something that could explain this situation here. This range setup looks as if it's an explanation for the sideways movement taking place. It would appear as if the breakout equivalent of this range setup, which coincides with this area, was hit by this spike. Now, in setting up for this trade, I had identified this range setup as well as the breakout equivalent. But the other aspect of it was that I also thought that it was possible that instead of it being a range setup, the market simply formed a pair of double bottoms and this in a brief uptrend followed by a break that led to the continuation of downtrend. So I was in two minds as to whether or not this was actually what was taking place, or whether or not it was actually a range setup. So it looks as if the answer is now clear, that in fact it was a range setup and that the breakout equivalent of that range was hit. So the lesson from this trade is that whenever we're in a situation in which we have two alternative interpretations of what we see on the market, on the charts, it is best to avoid trading altogether. So this is a lesson learned in terms of when to trade when there's some element of doubt in terms of where targets are and whether or not the trade has a high probability of success. So this is a lesson learned here. So it's a small loss, and given the fact that breakout equivalents normally lead to sharp pullbacks, we could have actually let a much larger loss and could have actually taken out our stop loss. So pretty fortunate in this situation, but again, the emphasis is on the fact that we have to be very careful, and we always have to even scroll back to take a look at what has been happening further earlier on the chart, especially when you're talking about large time frames, and analyze the market from all sides. And if one of those interpretations would actually mean that we should not take the trade, then that is exactly what we should do. Avoid the trade and wait for another clear opportunity to take place. So overall, a small loss. Again, it could have been worse, but in the general scheme of things, the rate of return so far of 33% is still pretty good for the time period that we've been using this methodology, and it's still comparable to the rates of returns of the industry benchmark, as you can see here in the Barclays top 10 ranking for 2014, as well as so far in 2015. So in a nutshell, these types of spikes tend to coincide with sharp periods of risk aversion, and they normally lead to the breakout equivalent of a range being hit, and trading it following these spikes is normally generally very risky. So lesson learned, and we'll move on from here.